In this cassette, we'll examine buyer-seller negotiations. Specifically, we'll look at how buyers and sellers gain leverage and identify the critical factors affecting the outcome of these negotiations. We'll discuss several commonly used tactics, examine guidelines for conducting buyer-seller negotiations, and we'll go over some of the do's and don'ts of buyer-seller negotiations based on research findings and our interviews with several experienced negotiators. There are many different types of buyer-seller negotiations, such as real estate deals, the contracting between purchasing agents and suppliers, and the negotiations we encounter when buying a car or a major appliance for our homes. Here we'll focus on a single type of buyer-seller negotiations, namely those involving the mergers and acquisitions of companies. We'll use the experience of our panelists, who are specialists in this type of negotiation, to examine the dynamics in other types of buyer-seller negotiations. Our first interview is with Mr. Neil Ryan, a general partner of the Cumberland Investment Group located in New York City. Prior to his present position, Neil was president of General Telephone and Electronics Corporation and president of the Randolph Computer Corporation. He has vast experience in a variety of buyer-seller negotiations, including negotiating for investment financing, marketing negotiations, and in the buying and selling of companies with settlements ranging from $1 to $20 million. My first request to Neil was to help us identify the types of leverage used in the purchase and sale of companies. Neil stresses the importance of maintaining control over your negotiating team and keeping clear channels of communications between buyers and sellers. Neil, in this wide variety of negotiations that you've been involved in, are there various types of leverage that are used in these negotiations?
I think the ultimate leverage, to me at least, is doing your homework beforehand, knowing what your position is, essentially what the corridor of your position is. And by that I mean whether you're buying or selling, you have a price. And whether it be hard goods or soft goods, and I don't mean soft goods in the textile sense, but whether you're selling a concept or selling something of monetary value, do your homework to know what your position is relative to the other side. And the homework takes place on several levels. For example, a sale of a company or a division, and you're on the selling side. You want to determine from a very practical and balance sheet and P&L point of view what that company is carried on the books at, so to speak. Then you want to determine just how important is it to sell it, and what are your true options within the environment that you're negotiating. Often it may turn out that the seller doesn't have very strong options. It's impractical to retain the division, or either emotionally impractical or from a business point of view. That starts to get plugged into your pricing, and that gives you, say, a high and low price. And it may be below the actual carrying value of the company. And then you've got to use that leverage, to use your word, in persuading the client that forget the balance sheet, it should be sold for thus and so. Might be substantially below the balance sheet, or in some cases might be above the balance sheet, regardless of what that actually depicts. So point number one is really doing as thorough an analysis of the factual side as well as the actual environment which surrounds the transaction. Then you move from there. Once you think you've identified a buyer, and try to put yourself in his head and determine what kind of a price is he likely to, and when I say price I don't mean one specific number, I mean a range that it probably makes sense to him. Now, I do this by spending a fair amount of time trying to understand what the objectives of the buyer are, what he's trying to accomplish, what he thinks he sees in the property that's being sold. Conversely, if I'm the buyer, I think that through very carefully. I know what it's worth to me, and I put a upper and a lower price on that and do not go beyond that unless something comes up during the course of negotiations which modifies or changes my view. But you go into the negotiations, be you buyer or seller, with the leverage of knowing what your position is going to be. That's one comment I'd make on leverage. The next leverage, in a sense, is to stop. There's an old expression someone said, probably Ben Franklin, but I'm not sure. You never hear anything when you're talking. You never learn anything when you're talking. You only learn when you're listening. To learn to be a good listener and learn to be a good observer of people, their facial expressions, their body expressions. And I'm not particularly an advocate of it, but it's just something that over the years you spend a lot of time looking at how people are responding to what you're saying, listening for words and nuances, and there's an awful lot of fencing that goes on in most negotiations. The rare negotiation is when two parties see the same elephant from the same perspective and quickly come to a deal. It's rare in my experience. In somebody else's experience, it may be less rare. More often than not, you must spend that time really trying to understand the other side and what they're driving at and what they are really saying as opposed to what you think they're saying. And I think you can gain and keep and use, quote, leverage, unquote, if you proceed along that basis. You can also save an awful lot of time, because if you can see that your position and the position of the other side is totally out of whack with each other, then you better know that early as opposed to late. And one of the things that I've consistently done is when I've reached the point where I think I'll have the first pricing discussion, I will begin to discuss my objective, say in terms of price, somewhat higher than my highest value or around my highest value, without really being terribly specific. My objective there is to determine whether we're in the same ballpark. If I say I think it's worth 10 and the other party says it's worth 1 and convinces me that he really thinks it's worth 1, well, conversely, if I say it's worth 1 and he says it's worth 10, I would prefer to know that as early as possible within the negotiations. And if I can determine that we're that far apart and there's no way of getting the two sides together, then I'd break it off and try to find someone else to discuss and negotiate with. That's not a matter of leverage so much, perhaps it's a leverage to save time. The most critical aspect of any leverage, of any negotiation, is the close. There must be 100 deals opened and 10 of them close, or 5 of them close, or certainly some small percentage. And I think you can derive negotiating leverage by staying on top of the transaction, because as it proceeds through the business stages and reaches a point where there is a business understanding between two parties, then your lawyers and accountants begin to get more and more involved. And it's an old saying, and I'm sure it's probably been repeated many times, but I think not everyone that's been involved in this kind of area has seen a number of transactions either totally derailed by an attorney or an accountant, or certainly derailed to the point where it takes a lot of time to get it back on track. So the leverage point I'm talking about here is to keep control over the people that you bring in to work for you and with you, and keep control of them in a variety of ways. Keep very close to the seller or to the buyer. Make sure you have an open channel of communications that is not being blurred by having to go through an attorney or an accountant or what have you. Make sure that you understand your own motivations and the motivations of the corporation for whom, or the organization or group that you represent or work for or are representing yourself. And you find that you put 10 people in a room and you have 10 not entirely different motivations, but sufficiently different that unless you spend the time to understand these, really, I mean, say not spend the time, unless you open yourself up to understand them, then deals can get blown right out of the water. Specifically, something I'm working on currently it's clear to me the attorney on the seller side is close to being desperate to want to sell this company. It's equally clear to me the controller or accountant type is playing a very kind of almost clever political game where no matter which side you come down on, he's one step ahead of you or one step on the other side without ever declaring himself. So as I attempted in this particular negotiation to get instructions from, direction from the seller as to pricing, I spent perhaps upwards of 2 months on a part-time basis. So until I finally concluded that I was going to get no direction whatsoever from this organization, in spite of the fact that I was acting really as a financial consultant to them and expected them to price the company. And I expected to be able to respond to that price and say, I think it's unrealistic, or it's realistic, or I'll try whatever you want me to try. I got nothing. And that stems from the particular political environment of this corporation and this particular individual. If he doesn't give you any direction, he can always be critical of whatever direction you take. Is that a matter of leverage? You know, it depends again on how much you want to define that term.
In some of the types of examples that you've given us of leverage, does power ever play an important part in the negotiations?
Well, it would obviously be rather naive to say that power doesn't play a part in every negotiation. Power is one of those words, perhaps like leverage, that has innumerable definitions. I would go back to the point I made earlier that, in a sense, the ultimate power is knowledge of the facts and perception of reality on both sides, insofar as you can do that. With that knowledge, you then have automatically accruing to you a good deal of power over people who are perhaps only spending part-time. Number two, be aware of people's personal motivations and never take them for granted. I go back to this earlier example. I learned that my messages, my reports, verbal reports, were being filtered to the president of this company in a manner that was not representative of the facts, so that I no longer reported or verbalized what was happening until I also did the same with the president. I took it for granted, and I was wrong, that my comments were being accurately translated.
Neil's comments suggest several guidelines for buyer-seller negotiations. First, he emphasized that there's no substitute for homework in identifying the settlement range. That is, the difference between the most a buyer will pay and the least a seller will take. This is not only based on the facts, but also how each side perceives these limits, the difference being perceptual as compared to the realistic computation of dollars and cents. As a result, both parties have to establish in their preparations not only a settlement range in their own minds, but also the tactics and countermeasures each will use to influence the other party's perception of that range. As in any negotiations involving a compromise settlement, a critical part of this bargaining process is the getting and granting of concessions. In buyer-seller negotiations, an important part of developing concessions includes recognizing available give-ups. A give-up is something you can give to the other side at a lower cost than what they would have to pay in the open market, and which would result in a benefit to the other party. Give-ups include financing arrangements, training, service, discounts, delivery preferences, earn-out arrangements, and other benefits you could offer in return for a concession which would cost you less than what you would get in return for a concession from the other party. These give-ups are also important in developing alternatives which can be proposed during the bargaining process. A second factor in developing a settlement range, which involves careful preparation, are the economic realities of a proposed transaction. These economic realities include price fluctuations, industry economic conditions, the cost of money, and the labor supply. The availability of alternative products or services and the potential of new methods of production are also important for a buyer to consider. Likewise, the seller must consider the demand level for his product or service. Another guideline in preparations is knowing the organization with whom you're negotiating. This requires studying its performance track record, its management structure, and the personalities involved. Are there any hidden personal motives of those involved in the negotiations? How are decisions really reached in this organization? There are many sources of information that can be tapped to find the answers to these and similar questions. Start by interviewing employees in the other party's organization, employees in the accounting, quality control, production, and engineering departments. Follow up on past performance. Contact banks, auditors, consultants, suppliers, customers, credit bureaus, mutual acquaintances, previous negotiators, trade publications, local newspapers, and former employees. Finally, analyze any previous negotiations you have had with this organization. What were the personal needs involved? What demands were made? What tactics were used? Who attended the negotiations? What was their conduct and behavior? What types of concessions were granted and made? Another important part of your preparation is knowing the decision-making process in your opponent's organization and who really makes or influences the final decision. This goes back to Neil's point about staying on top of a negotiation, keeping control not only of those representing you, but also making sure your position is being accurately reported to the decision makers, and whether or not you're actually dealing with the person who will make the final decision. This last point raises the question of whether or not a member of a bargaining team should have final authority to make a decision. If a negotiator has final authority, he has the ability to make a quick close, to capitalize on a momentary advantage, and he strengthens his credibility vis-a-vis the other negotiating team. However, it also puts him at a disadvantage because once a negotiator is known to have final authority, he can't buy time to review his position by indicating that he doesn't have power to make a final deal. Let me go into that a little further. A common tactic in the late stages of a negotiation is for Party X to indicate that a final decision requires a higher authority's approval. As a result, Party X gets additional time to consider its position and also has the option of bringing in a new negotiator to bargain with Party Z. This change the negotiator or escalating authority tactic has serious disadvantages for the opposing team, since it is now dealing with a new negotiator and has to start bargaining all over again. The intention of this tactic is to wear your opponent out physically as well as psychologically. By passing the approval and authority level higher and higher, the opponent must repeat the negotiating process at each level. This creates tremendous stress on the negotiator and may result in a lowering of his expectations and demands. It could also put him in an uncomfortable spot if he reports to his organization that an agreement was reached when in actuality it had not. The easiest way to avoid this kind of trap is to simply ask, question the other side on their level of authority. There are also several ways of dealing with the escalating authority tactic once it occurs. We can neutralize their escalation by escalating ourselves. We should be prepared to walk out. We can avoid a repetition of our arguments by going directly to the top of the organization and state our objections to this tactic. In the event the new negotiator changes his position, we should feel free to change ours. If possible and practical, we should have solid reasons to halt the talks until the original negotiator becomes available. Finally, it is also a good idea to keep our superiors informed of how these tactics are being used to reduce our expectations. Let's now turn to an interview with Mr. Dan Angeloff, who is president of his Los Angeles-based firm, the Angeloff Company. Dan specializes in advising top management in the negotiations surrounding corporate financing, mergers and acquisitions, and investment decisions. In our conversation, Dan describes other sources of leverage used in the merger and acquisition process. In particular, he focuses on the importance of not appearing too eager in buyer-seller negotiations, and he gives us examples of the tactics buyers and sellers use in going through this fencing process and its impact on establishing a settlement range and the final deal. You've been on both sides of the table in advising both the company who is buying an acquisition and the selling company itself.
Yes.
What are the ways in which the two parties try to gain leverage or influence each other during the negotiations for the acquisition or merger?
Well, from the buyer's side, Ed, assuming the buyer is a larger company, which normally is the case, assuming they're publicly held, which can or cannot be the case, that there is public information about the buyer is larger, so therefore the seller is looking up to the buyer. The buyer normally will have greater resources than the seller, because that's maybe one of the reasons the seller wants to sell, is to establish a greater capital base for him to grow, because he's grown as far as he can within his own framework. So that financially there can be a dramatic leverage factor. The size of the company would be a leverage factor that could really have a material effect on the seller themselves. An example of the impact a buyer may have, in one of the negotiations I had with a large national food company who came out to look at the potential seller on the West Coast, the president came out with two pilots, his chief financial officer, chief operating officer, and two lawyers. And he came in the first meeting with the principals and overwhelmed them by just the number of people that he brought. He then overwhelmed them when they were sitting in the conference room, since one of the prerequisites that I recommended, that since these companies were number one and number two competitors in the marketplace, that there be a good faith, non-refundable option, that before the selling company would turn over any of its internal financial statements, since it was dealing with its number one competitor, they would have to, they being the potential buyers, come up with a reasonable amount of money that would apply towards the purchase price if they were to go ahead with it. But if they were just trying to find confidential information about the seller, it would cost them dearly. And this amount, as I recall, was $50,000 as a non-refundable option to look. Well, the president pulled out an envelope from his jacket and counted $1,000 bills. He had $51,000 bills, and that was rather influential to the sellers.
How do sellers try to influence the settlement process in terms of the price that's to be agreed upon?
Well, the sellers, if they know they have a highly interested buyer, will try to be maybe a little aloof and indicate, just like a girl who's courting, that she has many boyfriends. And so he will not come to the party with any open arms, and consequently is reluctant. He indicates that he has other people who are interested in him and tries to influence the potential buyer on the smartness of his management, the benefit of his product, and really tries to convince the buyer that he's dealing with an exceptional company and that he himself does not have to enter into this transaction, because if he, the seller, were to really relay to the buyer that he would have to, or he's very desirous of selling, then obviously the buyer would have the advantage in negotiating with him.
Are there any other tactics or ploys that a seller would use to his advantage?
Well, certain sellers have just not been available for potential buyers at a specific time, knowing that they'll go back to them, at a later date. Sellers will have maybe negotiations with someone that they may not really deep down know they're going to enter into a transaction to get the buyer that they really want to acquire the company's interest. And there are tactics like this that are used in trying to stimulate the buyer's interest.
How does power impact the buyer-seller negotiations?
Well, the power again is one in which the buyer, normally being larger, he has a overview of many companies. He's had an experience of acquiring many companies or looking at many companies to acquire, whereas the selling company is normally doing this one time. And so that he is awestruck by the effort that he's involved with, plus he's awestruck by the size and the dominance of the company that's looking to acquire him, but has to be realistic enough to know what true value there is to induce him to make a transaction, so that the number of people, the size of the company, the company's track record, maybe the company's business, which is substantially different than his, the length of life of the company as compared to his, the depth of management as compared to his. These are all dynamic factors that he wants part of, because that's one of the reasons why he wants to go upstream, in effect.
Are there any indirect ways in which a buyer would attempt to pressure a seller into selling his company?
Well, yes. When you say indirect ways, there can be direct ways. If they're competitors, the large company has substantially greater resources than the small company, and he says, well, instead of selling my product and getting a 5% margin of profit, I'd be willing to reduce my margin of profit so that I could maybe make this competitor in the field a little more desirous of talking to me.
Is that a common tactic?
Well, I wouldn't say it's a common tactic, but it's one that's not uncommon, because that's in good competition. You're trying to sell your product at a price which gives you as good a return, but is competitive in nature against your competition.
Based on your experiences in acquisition and mergers, I'd like to ask you some questions in that area.
Sure.
What are the critical factors which affect the outcome of mergers and acquisitions?
I'd say the critical factors which affect the outcome is the seriousness and the planning of both buyer and seller. Are they really sincere in the effort that they're contemplating in negotiating to purchase? Do we have a sincere purchaser? Do we have a sincere seller? I think those are really probably the most important keys to merger transactions actually going together.
How do you determine the sincerity of both buyers and sellers?
Well, one would be the experience they've had in the past looking at their corporate growth. Have they been growing by acquisition? If they have, then obviously they've had experience in acquisitions. Also, the time and effort they take in going through the acquisition search, the attitudes they have in talking to potential buyers, the consideration that they're prepared to pay for purchasers, or sellers, I should say. These really are the fine points, I think, in determining if you have a legitimate seller or a legitimate buyer.
How does the sincerity affect the outcome of negotiations? Does it affect the quality of the negotiating process?
Well, the sincerity, let's say the sincerity of the head of the company acquiring or negotiating to acquire another company could very well affect the outcome of his being successful in acquiring the other company, because the president of the selling company has to live with the president of the buying company, and if he feels the buying company is not sincere, irrespective of what price he may offer the president of the selling company. The selling company president may just not like to work with a person which has this type of personality. So it's very important.
What have been some of the most interesting negotiations that you've witnessed in the acquisition and merger area?
Well, I would say that some of the interesting experiences I've had, in one case, I went through approximately 14 months of intensive negotiation representing a selling company with the same buyer. We went through about 15 offers and counteroffers. At about 8 months in the middle of our negotiation, the company was supposedly sold to foreign interests, the sellers, and then the negotiations continued. The president of the buying company happened to be a person who lived in the Midwest and who woke up around 4 o'clock in the morning, which is 2 o'clock Los Angeles time, and he would have a tendency to call me around 4 o'clock in the morning to find out what new had happened the day prior.
He would call you at 4 o'clock in the morning in Los Angeles?
In Los Angeles,
at your home?
At my home. And I would get so used to his phone calls that I would just roll over in bed and pick up the phone and say, hi, you know, and talk to him from that point of view. So that was a very unusual, interesting negotiation to the extent of how long it took, the many climaxes, the many feeling of elation and frustration when the negotiations broke down, and finally relief when they finally were concluded after a substantially long period of time. It's very unusual.
14 months is quite a long time.
Is a long time.
Now, did you say that that company was eventually bought by a foreign interest?
No, it was almost purchased by a foreign. In the 8th month when we were negotiating,
I see.
those negotiations broke down, and then we continued the negotiations with a Midwest company, which eventually acquired the West Coast company.
Were you representing the buyer?
No,
weren't you?
I was representing the seller. Yes.
What types of strategies were used by the seller, or did you advise the seller to use in the offers and counteroffers?
Well, basically, the strategies I tried to advise the seller was that he did not have to sell, number one. So he was not a seller in distress. Secondly, we wanted to make sure that the activity that he was undertaking, although it was psychologically impacting, did not impact his business decisions, because the probability of acquisitions have a very high mortality rate. That's one of the occupational hazards of mergers and acquisitions, that for every discussion there may be 50 discussions to one serious discussion, and maybe 100 discussions to one real transaction being affected. So that the mortality rate being that high, I wanted to make sure that the principals of the selling company knew they did not have to sell. 2, that they conducted their business as usual during the heavy negotiating process. And 3, that these discussions were held very confidentially, because if the discussions came out to their other competitors, that would affect their business. So that those were some of the things that I tried to do to advise the company during the negotiating factors. But Ed, there have been times when I've been brought into a company maybe a year or 2 years before sale, and the company said, you know, we're interested in selling. We need some professional advice of how to prepare ourselves for the eventual sale. And then I've gone in and advised the company of what they should be doing, how companies that are acquiring companies are looking for profitability, how many of your acquiring companies are publicly held, and therefore their attitudes are to maximize profitability as public companies, since the public pays for their earnings, as opposed to minimizing profitability as a privately held company, trying to minimize taxes. and consequently there is a fine balance there. A company obviously will try to write everything off privately held to minimize the taxes he has to pay Uncle Sam. On the other hand, if he's publicly held, he will try just the opposite, to try to maximize his earnings, because the value of his securities are strongly related to his earning and his earning power. So I've gone in and advised companies to prepare them for the acquisition and merger activity to be sometime in the future, anywhere from 6 months to maybe 24 months.
In this pre-negotiation phase, are there any strategies that you've advised that are in addition to the economic ones, non-economic areas?
Yes, I would say that generally speaking, when I've come into the pre-acquisition activity, is what I'll do is a corporate audit of their board of directors to see if they have a board that has the proper background and experience to be entertaining a merger offer. Many times privately held companies really have a little credence on their board of directors. Maybe the principal and his wife are the only ones that are on the board. I'll go in, and if the selling company has not had a certified public audit, we'll recommend that we bring a recognized accounting firm to do their year-end certification. Certainly we will want them to get good legal representation, even though the proposed transaction may be some time off in the future. We want to position them in relation to their management. They may have a thin management base, and during this period we may want to increase its management depth by bringing other people aboard, so that when a potential buyer comes in and he says to the president, what happens to the company if something happens to you, that there'll be some continuity. So that there are a lot of areas that are very important considerations in the pre-acquisition mode of a company that is eventually acquired.